The Industrial Revolution was financed by banks. Actually, it wasn't. Walk with me through this section of the exhibit. Here's the conventional story. Factories needed capital, so respectable financial institutions emerged to meet that demand. Banks, building societies, credit unions, they are the heroes of urban growth. The machinery of modern lending simply responded to progress. Clean narrative, widely taught, almost entirely incomplete. But look at this telegram right here. It's from Manchester, 1847. A factory foreman borrowed money at 40% annual interest, not from a bank. From a man named Clegg, who lived 3 streets over and kept his records in a cloth notebook. Clegg wasn't a banker. He was a grocer with cash and no scruples. This is the first piece of the real story. Industrial cities exploded between 1780 and 1880. Manchester's population went from 25,000 to over 300,000. London swelled even larger. Millions of working people migrated to these places chasing wages. They needed housing immediately. They needed tools, food, rent advances. Banks wouldn't touch them. The formal banking system required collateral, land, property, a track record. A textile worker had none of those. So what filled the gap? Unregulated lenders, pawnbrokers, tavern keepers, landlords who doubled as creditors, local merchants. They operated without licensing, without rate caps, without disclosure. And they became the actual financial backbone of urban expansion. Here's the irony, and this is where the accepted story starts to crack. These unregulated lenders were more efficient than banks at solving a real problem. They lent in small amounts. They moved fast. They knew their borrowers personally. They charged high rates, yes, but they also took genuine risk that banks refused to take. Without these loan sharks, urban housing wouldn't have expanded as fast as it did. Workers couldn't have afforded rent deposits. Small shopkeepers couldn't have stocked inventory. The factories themselves couldn't have sourced enough nearby labor because workers couldn't afford to move. The Industrial Revolution needed unregulated credit more than it needed pristine banking ethics. Now we reach the real explanation, the part that explains both the system's necessity and its cruelty. Unregulated lenders filled a gap that formal institutions wouldn't touch because the profit margins were too thin and the default risk too high. But because they operated outside any regulatory framework, they could also exploit that captive market mercilessly. A worker might borrow 5 shillings for a week's rent. The interest was structured to compound weekly. Miss one payment and penalties kicked in. Many borrowers rolled over their loans month after month, paying only interest, never touching principal. The debt became permanent. This wasn't incidental to urban growth. It was the mechanism that kept workers dependent and immobile. Consider what this meant. Urban landlords often were the lenders. They'd advance rent money at punitive rates, then collect rent plus interest from the same wages. The worker was trapped in a cycle designed to extract maximum value while keeping them perpetually undercapitalized. They couldn't save. They couldn't move. They couldn't refuse. The genius of this system, and I use genius deliberately, was that it didn't require violence to enforce. It required mathematics. As long as interest rates exceeded wage growth, the lender won automatically. The system perpetuated itself through simple arithmetic. By the 1860s, some cities began passing regulations. Rate caps, licensing requirements for lenders, disclosure rules. But these regulations didn't eliminate unregulated lending, they drove it underground. Lenders simply became more secretive, more aggressive, more willing to use intimidation because they now had criminal liability. Here's what's crucial to understand. The Industrial Revolution's urban explosion wasn't a story of financial inclusion. It was a story of managed exclusion. Workers were included in the labor market but excluded from stable credit. That exclusion created a parallel lending system that extracted wealth while appearing to provide it. The system worked this way. Formal banks made safe loans to factory owners and merchants. Those borrowers paid reasonable rates and built wealth. Unregulated lenders made risky loans to workers at punitive rates and extracted wealth. The gap between these two markets wasn't a failure, it was a feature. It ensured capital accumulated upward. This pattern didn't end with the Industrial Revolution. It persists today in payday lending, buy now, pay later services, and subprime credit. The mechanics have evolved, but the principle remains identical. Create a parallel lending system for those excluded from mainstream credit, charge rates that ensure they stay excluded, and call it progress. The loan shark wasn't a villain who appeared and then disappeared. He was a structural necessity, and remains one, as long as formal credit systems exclude large populations. Understanding how he financed the Industrial Revolution isn't just history. It's a template for recognizing how parallel credit systems work in the present. The real mystery, looking back at these documents, isn't why loan sharks existed. It's why we keep acting surprised when they reappear in new forms, serving the same function in the same way. The conditions that created them never actually went away. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for deep dives into how lending systems shape history and structure inequality. We examine a new case every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.